So for the safe plate of your barbell, should you use a utilities fund? All right, so remember the barbell approach is we have a 45-pound plate here on the left, and that would be comprised of our cash or savings or money market accounts, our CDs, whatnot, in the Ginnie Mae, what I talk about a lot. Then you got the bar, then you got the other plate, 45-pound plate on your barbell, which is comprised of stocks, maybe a Wellington fund. So a lot of people have been asking how about using a utilities fund as part of the safe plate on that, simply because utilities fund is fine, old, stodgy, just grandpa's stock, where they're regulated, so there's not much growth, they're not going bankrupt. They have a high dividend yield and whatnot, pretty plain vanilla stuff. And the answer is you should not. So we'll dive into that by looking first and foremost at the Vanguard Utilities Fund, which only goes back to 2004. So we got 15 years of a track record to include the major year of 2008. For some reason, I can't pull this up on Vanguard to read you what the website says on my Apple. I'm not sure if it's because of the Safari browser or whatever Apple uses. But on my Chromebook, I have it here. So the Vanguard Utilities Fund is Admiral shares. And I can't remember what you have to it used to be how to have $100,000 to invest in Admiral shares. Might be $10,000 now. But there's also an ETF as well for Vanguard Utilities. So let's just read what the fund says from Vanguard itself. The low-cost fund offers exposure to the utility sector of the U.S. equity market, which includes stocks of companies that distribute electricity, water, or gas, or that operate as independent power producers. The main risk is its narrow scope. Invest solely in utility stocks. An investor should expect high volatility from this fund, which should be considered only a small portion of an already well-diversified portfolio. So they're already telling you expect high volatility. And so what happens here is you don't want high volatility in the first bucket or the first plate of your barbell. So let's just look at the Vanguard, this right here. My man Daniel showed me how to take the info from Yahoo Finance. So you go to Yahoo Finance, you go to Performance, and you're able to just cut and paste the annual returns into the spreadsheet and just kind of manipulate this this formula that he created. Is freaking awesome. I tell you, this is huge for me. Anyway. So this is fantastic. So let's go back to we'll go to profile, 6.28 billion. So for Vanguard, pretty small, 4-star rating. Again, it's been around since 2004. Let's see what we got. Expense ratio, 0.1% or 10 basis points. Right now, it's paying 2.66 according to Yahoo. Let's see what it's paying according to Vanguard, if it tells us differently, because sometimes Yahoo stuff is a little bit odd. 2.83 according to Vanguard as a dividend yield. Just a good fund, man. No other way around that. If you look at the holdings, you'll see the holdings are pretty, commonplace stuff that you would be familiar with. Let's see. Dominion Energy, Duke Energy, Southern Company, Exelon, Sempra, Excel, Consolidated Edison, PSE&G, Public Service Enterprise Group. Duke. Do we talk Next Era? In fact, that's weird. Next Era is 11% of his holdings. Nuts. Anyway, so at the end of the day, let's take a look at what his has done since 2005. So since 2005, it's averaged 10.73%. Ginnie Mae since 2005 has averaged 4.02. And again, the Ginnie Mae, the reason I like the Ginnie Mae for that plate is because it's not very risky. In fact, the Ginnie Mae had one down year in 2013, and that was down 2.23% in this 15-year time frame. This was down 28% in 2008, so this was actually even down more than the Wellington Fund. It was down 5% in 2015. So we have a standard deviation of 13.76. Ginnie Mae standard deviation of 2.94. Look, at the end, now it's average 10.73, so it's smoked the Ginnie Mae in terms of returns, but we're not trying to get this plate of the barbell. We're not shooting for returns. We're shooting for safety to get a little bit more yield. So the Ginnie Mae, has got dwarfed in return, but that's you got to expect that. That's actually what we're looking for, and it's got 2.94 volatility. So yeah, this is average about 2.5 times the return of the Ginnie Mae, but about 6 times roughly. 5 times volatility. We don't want volatility, so don't use a utilities fund to get volatility. Don't use a utilities fund in the first part of the barbell. It just doesn't make sense. The utilities fund needs to go in the stock portion of the barbell. That's all there's to it. If you want to add utilities, I got no qualm with that. You know, I don't know how much diversification you're really going to get, though. I mean, the S&P 500 is down 5% this year. S&P 500 last year is up 30%. You know, S&P 500 is down 37% here. So, I mean, I don't know, it looks pretty correlated to the S&P 500. And the reason for that is some of these stocks that are in here are going to be in the S&P 500 for sure. So, look, if you want to go that specific, that's fine. You don't want to add this to your safe part of your portfolio. All right, hope this helps. Love to hear your questions. Thanks now.